Hello friends, we are once again with the video on balance of payment. Hope you have liked the previous videos on balance of payment, and if you have liked, please share and press the ring button so that you get the further notifications. And today we will be discussing the concept of balance of current account, balance of capital account, and the causes of disequilibrium in the balance of payments position, and the concept of balance of payment always balances. Now, first of all, we must know what is balance of current account. You must remember the balance of current account consists of balance of visibles. Visibles means visible items of trade, that is export and import of goods between countries. Invisibles here means the trade in services. That means you must know that the factor owners render factor services abroad, for which it receives income in the form of rent, interest and profits. And there are also non-factor services like the services provided by the Shipping Corporation of India, then Travel and Tourism Department, which gives services to the foreign visitors who come for tour and travel in India. Similarly, our communication services, banking services, insurance services, these all constitutes of non-factor services. And besides that, it also includes balance of transfers. Balance of transfers here means the unilateral transfers between countries. Like for example, it includes the war indemnities given by one country to another for war damages, then the economic aid given by one country to another in times of natural catastrophes. In recent past, you have seen that Indian government has sent 40,000 tons of wheat to Afghanistan. Similarly, it has supplied vaccines for corona across the world in times of pandemic. So these are the examples of unilateral transfers between countries. So it is a measure of all payments that are made for currently produced goods and services plus non-trade flow of funds between a country and the rest of the world. That is called as balance of current transfer. Now, non-trade flow of funds includes factor incomes. That is the factor incomes which is received by the residents of a country for rendering factor services abroad. Like for example, the resident workers of our country may get employed themselves abroad, for which they may receive wages and salaries. Similarly, the non-resident workers may get employed themselves within the domestic territory of our country. They may receive wages and salaries for their services. So that is what? That is the compensation of employees paid to the non-resident workers who are working within the domestic territory of our country. Now, similarly, it includes when we invest in shares or securities or bonds of foreign companies, we receive interest, dividends and profits. So that income arises out of portfolio investments or foreign direct investments. And similarly, foreigners also make investments in India. Like for example, you have seen that Apple has invested billions of rupees in India to manufacture mobiles. Similarly, for manufacturing microchips, the Taiwan, a company of Taiwan has invested, planned to invest 200 billion dollars in Gujarat in association with an Indian company. That is a part of what? That is a part of foreign direct investments. So what we find that here the balance of current account therefore consists of balance of export and import of goods between one country and the rest of the world. Secondly, it includes the balance of invisible items of trade, that is services, that is non-trade flow of funds between countries. As I have said just now, that it includes flow of factory incomes, which includes wages, interest, rent and profits. So this is another aspect. And what we find, it also includes the flow of funds for non-factor services like banking and insurance or shipping or telecommunication services between countries. And the international unilateral transfers, that is current transfers between one country and the rest of the world. Now, since international unilateral transfer constitutes an insignificant part of the balance of current transfers, therefore it is actually ignored for calculating balance of transfers. So that includes balance of visible items of trade and balance of invisible items of trade, which includes the flow of funds from factor services that are rendered abroad and flow of funds arising out of non-factor services that are made abroad or that flows into our country. That represents balance of current account. So this is the concept of balance of current account. Now we will be discussing the concept of balance of capital account. Now the second thing which we are going to discuss is balance of capital account. Now, balance of capital account shows the movement of capital between countries, which includes borrowings and lending from abroad. Secondly, it includes purchase and sale of assets, both physical and financial, between countries. And what? It includes export and import of capital. Then gold and foreign exchange. So this constitutes a part of balance of capital account. Now you must remember it has two important components. One is autonomous capital flows or autonomous transactions, and the other one is accommodating capital flows or accommodating transactions. Now remember, autonomous capital flows arises out of normal economic considerations, like it may arise out of the portfolio investments or foreign direct investments that are made by other countries in our country or by our country or residents of our country in other countries. So that constitutes a part of what? Part of autonomous capital flows. Like for example, recently you have observed that the Apple Industries has invested money in settle. So recently you have seen that Apple Industries Limited has made investment in India, and is manufacturing iPhone mobiles. Now that is what? That is a part of foreign direct investments. Similarly, Tata Motors, then the Tata Steel, they are making investments abroad. So there is flow of income in the form of profits from rest of the world. Or we may make portfolio investments. That means when the residents of one country make investments in shares or securities or bonds of other countries, there is a flow of income in the form of interest, dividends and profits. So that is a part of autonomous capital flows. Now on the other hand, accommodating capital flows are generally undertaken to bring the balance of payments position into equilibrium. Now when there is deficits in balance of capital account, when there is deficit in balance of current account arising out of excess of imports over exports, this deficit is overcome or recovered through accommodating capital flows. That means in this situation, in order to bring about equilibrium in the balance of payments position, the government may either borrow funds from the rest of the world like IMF or Asian Development Bank, or it may borrow from other countries even. So that is a part that is being undertaken to finance the deficits in balance of payment. Secondly, it may raise loans from commercial banks, or it may use its foreign exchange reserve or gold reserve to meet the deficits in balance of payment and thereby bring the balance of payments position into equilibrium. So this is the concept of balance of capital account. Now you must remember that balance of payment always balances, because it is based upon the principle of double entry system of accounting, where for every debit there is an equal amount of corresponding credit. Now when we export goods to other countries, there is flow of goods from our country to the other countries, and there is flow of foreign exchange into the country in the form of investments or in the form of money flows into the country. So in this situation, what you find that the flow of the exports is shown as a credit item, and investments of these monies into the shares or bonds or securities of other countries is shown as a debit item. So for every debit there is an equal amount of corresponding credit. So therefore balance of payment is always at balance. But in real practice you must remember that there may be either surplus or deficit in balance of payments position. Now in this situation, what we find that through accommodating capital flows, the balance of payments position is brought into equilibrium. Now we will be coming to the causes of adverse balance of payments position, or what factors lead to the disequilibrium in the balance of payments position. When there is fall in foreign demand means when the demand for our product in foreign or international market reduces because of change in taste and preferences of the foreigners, or increase in competition in the market, or might be due to changes in production technique by other countries, or due to increase in cost of production due to inflationary impact in our country. So that in that case the demand for our exports may decline, and that may lead to what? That may lead to a situation of adverse balance of payment, or there will be a deficits in balance of payment. Now secondly, what we find that when there is fall in production, the fall in production may be on account of failure of agricultural crop due to drought or flood. In that case, so domestic production of crops will decline, and in that case we need to depend on import of food grains from other countries. And similarly, if the industrial output or production decreases on account of what? Strikes or other factors, in that case industrial output also reduces, and that forces us to import goods from other countries, and that leads to increase the deficits and balance of payments of our country. Then comes demonstration effect. At times, demonstration effect means when we imitate the taste and imitate the other people, then that is called as demonstration effect. That means when a new brand of four-wheeler is launched somewhere in US, then the same is being on demand by the foreigners. So the rich people in India may prefer to have such brands of cars, and that may lead to increase in our imports, and thereby that may lead to what? That may lead to increase in deficits and balance of payment. Besides, what we find that so now we were discussing the next point. We are going to discuss the next point, that is inflationary pressure. So when there is inflation in the domestic country, what we find that the prices of goods in the domestic market increases. In that case, the country may go for import of goods, because imports are relatively cheaper to the goods which are produced in the domestic market. So that leads to what? That leads to increase in deficits and balance of payment. Next is when there is appreciation in the value of domestic currency. So when there is appreciation in the value of domestic currency, our imports become cheaper and exports become dearer or costlier. So in that case, our imports on the one hand increases, because foreign goods are now cheaper because of the appreciation in the value of domestic currency relative to the currencies of other countries. And on the other hand, exports becomes dearer, so there is a fall in exports of our country, and therefore that leads to further increase in deficits and balance of payment. Besides, what we find that it may so happen that there may be increase in cost structure of export industries. Though now when it happens, when the cost of raw materials which are used by export industries or the wages of labor increases, that increases the cost of production. So as a result, the prices go up and the exporters fail to compete in the international market, leading to the fall in our exports and thereby contributing or adding to the deficits and balance of payments position. So these are some important factors which actually leads to deficits in balance of payments position. Our last part. Now we have discussed that what are the causes of deficits in balance of payment. Now the question arises that how the same can be corrected. So the measures that are taken to correct adverse balance of payment position are: number one, depreciation. Now what is actually depreciation? When the value of domestic currency relative to the currencies of other countries reduces in the foreign exchange market because of what? Because of changes in demand and supply of foreign exchange in the foreign exchange market under flexible exchange rate system. It is called depreciation. Now, when there is depreciation in the value of domestic currency, what is its impact? It leads to a fall in the value of domestic currency relative to the currencies of other countries. Now, in this situation, our imports become dear. Why? Because now we have to make more payments for our imports in terms of foreign exchange. So, on the one hand, imports becomes dearer, as a result imports reduces. And on the other hand, the demand for our goods in the foreign market increases, that leads to the increase in our exports. And thereby it helps to correct the adverse balance of payments position. Now, the second measure that we can take is devaluation. Now, devaluation, when the value of domestic currency relative to the currencies of other countries are reduced by the central bank through its official action under the fixed exchange rate system, it is called devaluation. Now, you must remember that when there is devaluation of domestic currency by the central bank through its official action, our imports become costlier. And as a result, we are forced to reduce our imports. And on the other hand, our goods in the foreign market becomes cheaper. So that gives a boost to our exports. That means on the one hand, our exports increases, and on the other hand, our imports reduces. And that helps to correct adverse balance of payments position. Number 3, import control. That means at times the government may use import control measures in the form of tariffs and import restrictions. So, in order to correct the adverse balance of payment, the government may increase the existing rates of taxes like customs duties or import duties, or levy new tariffs on our imports. So in that case, imports will become dearer, and therefore we will be forced to reduce our imports. And on the other hand, what we find that it may also put restrictions on imports through import control. That means it may reduce the total volume of imports. Say in the previous year, the government had given a total import that the country can make to the tune of say $10 billion. Now in this year, this is restricted to $8 billion. In that case, what will be the effect? Import will be forced to be reduced, and consequently it will help to correct the adverse balance of payments position. Next is your import substitution. Now, in the recent past, you have seen that previously the government of India was mostly dependent on foreign countries for import of new production techniques, import of arms and ammunitions, then fighter jets, etc. Now what we find that this leads to heavy outflow of foreign exchange reserve from the country, and when there is fall in the value of domestic currency, our import bills increases. Now what the government is doing, instead of importing the same from foreign countries, the same is being domestically manufactured by the government and the domestic enterprises, private enterprises like Tata's and other Ambani's, or you can say Mahindra groups or Adani groups. So there is a joint venture, and the same, instead of being imported, is being manufactured in our country, and thereby that helps in reducing our imports and help us to correct the adverse balance of payments position. Besides that, the government may adopt the policy of a fiscal policy. Fiscal policy, as you know, is the policy of the government of a country whereby it manages its taxation, then its public borrowings and public expenditure to produce desirable effects on the level of employment, output and income, and reduce undesirable effects. Now, by using this fiscal policy, the government can restrict our imports. So, to reduce our imports, the government may increase the existing rates of taxes on individual income or property income. So, as a result, what will be the effect? The disposable income will reduce, and thereby that will help us to restrict our imports. That means the rich people now will not be in a position to import luxury items from abroad. Next is, that means the taxation on luxury items can be increased by the government to reduce our imports. This is another measure which can be taken by the government. Besides that, it may adopt control over the exchange, foreign exchange. That means it may put restriction on the amount of foreign exchange that will be available for import of goods from abroad. So that may also help to correct the adverse balance of payments position. And besides that, it can use monetary measures to control imports. In this situation, the central bank may increase the bank rates. It may purchase all the it may sell all the government securities in the open market, or it may increase the cash reserve ratio. So that will help to reduce the demand for investments and demand for consumption goods, which is financed through loans, and that will help us to control import of goods from abroad. So these are the few measures which can be taken to control adverse balance of payment or correct the adverse balance of payments position. Now I hope that these concepts are clear to you, and for the board examinees, I have a suggestion that the questions which you need to prepare for is what is the difference between balance of payment and balance of trade. Secondly, here you must remember that you may be asked to mention any 2 or 3 components of balance of payment, any 2 components of balance of payment. Thirdly, balance of payment always balances. Explain, or you may be asked that explain any 2 causes of adverse balance of payments position and how the same can be corrected. So there may be short questions, very short questions of 1 mark each. There may be questions of 2 marks each, and there may be questions of 2 and 6 marks. So these are the composition of marks which may be asked for. So if you like the video, I will ask you to ensure that you like it, subscribe the same, and press the bell icon, and to get the further notifications, I request you all to subscribe. Thank you so much. Wish you a very, very happy Kali Puja and Deepavali. Thanks a lot. Have a great day and great future ahead.